Hi, my name is Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this video where I'm going to be discussing if Bat Cypher and Gartley pattern Fibonacci ratios are necessary in the context of supply and demand, right? And really just came about this by I was going over some old Evernote notes, writing everything down, and I advise if you're a new trader, even if you an experienced trader, write things down unless you committed them really to memory and it becomes automatic. And you can see back in March 2014, I had some Gartley pattern rules, bat pattern rules, and I was going through these and looking at some other trade examples and things like that from back in the days. You can see I had these multicolored bars, indicators, RSI, MACD, and all that. Anyways, so just looking back on basically where I've come from, where I'm at now, and it had me thinking. I thought to myself, well, are the Bat Cypher and Gartley Fibonacci ratios necessary in context to trading supply and demand? And before we get started, I don't want anyone to confuse this with me taking a slight at anybody who trades this. If you're profitable trading this, then excellent, and it's just my thoughts on supply and demand, and really the thought process behind supply and demand, and is it really necessary to trade with Fibonacci ratios when and I've thought about Fibonacci. I've made a video on it comparing Fibonacci ratios to, for example, value ranges, and this is kind of a continuation from that video. But so if you're not familiar with Bat Cyphers and Gartleys, they're basically like harmonic patterns, and what you have is you have a move up, right? The market moves higher, right, and then it will retrace, and it needs to be traced back to, and this is going to be a Gartley pattern, this first one, to the 61.8 percent Fibonacci ratio. You need a move higher to maybe the 38.2, it's at 38.7, but 38.2, and then what you would do is wait for prices to come back down to at least the 78.6, 78.8 there, but it's 78.6, and then look to for either place a pending order or price action, and then you would look to pretty much set up your trade. Right now, all of this waiting for prices to do this and that in the context of Fibonacci, in the context of supply and demand, right? For me, and what I figured out, what is the most important is the X to A leg. This A, B, C, D leg is, I don't think it's actually that necessary. Yes, maybe when you're trying to get into trading, you're learning and things like that, then, and to set up trades and things like that. But the X to A leg is what is very important, and this is what I teach on the course, and also there's a free video on the introduction into supply and demand, right? Is if X, right, you got X to A, and let's just imagine that B, C, and D hasn't happened yet, right? So X to A, and then you start to get a retracement. What is X to A telling you, right? If X is a low and A is a high from a supply, remember this is from, you always got to think like how people think, and there's and psychology behind moves, right? X is where traders have deemed this to be a bargain level. They've bought, right? They're buying and buying and buying. A is where traders have deemed this to be an expensive level, right? Traders are no longer willing to push prices higher, right? So, and this is just fact, right? Otherwise, if this was a cheap area, if this was a bargain area, then prices would keep going higher. This is obviously deemed as the, we're looking back on the past, and this is always deemed as the cheapest area. So that just gives you the first clue, right? And now, if prices can't break higher than A, right, then we have an agreed value range between X and A, right? And what we mean by agreed value range is that traders have agreed that prices are valued between this price, this low, and this high, right? This is expensive, this is cheap. 50% level, you know, is fair value, right? In between an expensive, a low, and a high level, right? Now, you're always buying when it comes to a Gartley, a bat, or a Cypher below fair value, first of all, right? This B, C leg, again, is that really necessary? All this, you know, it could chop around for ages, right? And do, you know, higher lows, higher highs, lower lows, right? But regardless of what prices do in between the high and the low, the D, you know, area, which would be the 78.6, you're always buying at a bargain level. This is the absolute bargain, right? This would be the absolute bargain, and this is obviously providing, this is just technical analysis, by the way. We always do our fundamentals if prices do come down here, and this is worth, obviously, traders think that this is, you know, valuable still, right, or undervalued, then obviously you'll see prices, you know, go higher, right? So the D leg, right, and where D stops, it could end down here. It doesn't have to end obviously right here. It could end even, you know, around here, even just, you know, spike below X, right? And this would be, again, the best area to buy if you're looking, right? And obviously you're looking at obviously other levels of structure within this, you know, around this D leg and X leg as well, things like that, right? But the point being is that this B to C leg and the chop that maybe occurs in between, right, is it really necessary, right? Is it really, you know, you're just really just buying at value, right? You know that if you can mark an X to A leg, you know that below fair value is always going to be one of the best areas to buy. And the further down you go towards the absolute bottom, you're buying at an absolute discount. So when you see, again, with the bat pattern, you know, and you get a 50%, you know, pullback, and then you get that, why is, and this is just, again, just me asking the question, because I'm always, you know, trying to figure things out and, you know, think about things, but yeah, from a supply and demand perspective, why is Fibonacci, why does it matter that, you know, the 50% has to bounce from here and then has to go, you know, to the 88.6, I think that was it. Sorry, I did that wrong. That was the 88.6, right? Level, right? And this is, again, this is one of the reasons why these patterns do, you know, apparently it's been back tested, and these have, you know, high win rates. But it's because really all you're doing is buying at value, right? You're buying at a bargain price. So again, you can kind of figure out whether, you know, the software that you're buying, the, you know, the effort that you're putting into trying to find, you know, bats, Gartleys, and Cyphers, right, is worth it, or whether you can just put, as long as, you know, you can just identify an X to A, right, if you want to call it the X to A leg, right. I just call it a low to a high, where price is being contained, prices can't break above the high, prices haven't broken below the low. This is my value range. If do prices go below fair value, yep, brilliant, this is going to be an area. And then you look for obviously other you know, things in confluence, other levels of potential structure, you know, dynamic resistance, diagonal resistance, or support as well, in confluence with where you're buying from a value perspective, right? And if you notice, again, even with this cipher, right, you've got a higher low and higher high, and then you've got prices break past the fair value, and then you're buying really, again, I think it's 78.6 again, level. You're buying at really an area where this is considered a, you know, a bargain, right? If you're looking to be a buyer. So if you are trading Gartleys and, you know, bats and ciphers, and you are finding some success, this is the reason why, right? It's not any, you know, magical Fibonacci ratio level or anything like that. It's just look at where you're buying from a supply and demand perspective, right? And from a value perspective. You know, in my opinion, there's really no need to, you know, be trading with these ratios. But again, each to their own. But let's look at, again, kind of maybe like reinforce some of this this methodology on a price chart. So here's a real life example of basically what I'm talking about, right? Now we're on the dollar yen daily chart, and for the guys that are quite sharp, you can pretty much see where our pattern is, right? So let's find it. I think that's the one, right? So from a supply and demand perspective, we've got, well, actually from a pattern perspective, we've got the X to A leg, right? This is what's important to us from a supply and demand perspective, right? All this other stuff, right? The X to A to B, B to C, and it retraces back down to 33 point, yeah, so it's 38.2, right? Is that the right one? Let's see, 1 second. So we've got one. So actually this would be another good example, matter of fact, of why, again, following these ratios don't really matter, but no, it did. Right, so here we go. Right, and then you've got your completion at which would have been like the 78.6, right, which would have been somewhere here. Right, now in my weekly supply and demand technical analysis, I discuss why you should be buying or selling. I wouldn't say should, not financial advice, but the opportunities you have to buy or sell from a supply and demand perspective, right? But you can see here that we had already marked out our level of supply. This was a level of supply. If we're looking at it from an X to A leg, right, which is basically the high to the low, and again, if you watch my my video on the past week on released on Sunday, you'll see this, right? This here to here was where price has been contained. If you think that the Japanese yen is cheap up here, right, and expensive here, right, and also obviously with the Japanese yen, it's a risk currency as well. So Donald Trump has just pretty much come out and said something along the lines of, I was just reading it a sec ago, that if China, I think China gonna slap a $200 billion trade tariff bill on them if Donald Trump doesn't, remove his 50 billion or something like that. Something like they're having a little tit for tat anyway, right? Which is the reason why you're probably getting this this move, right? But anyway, getting back to the technicals, you from a supply and demand perspective, price is contained between the X and the A leg. Prices, whatever they do in between here, all you need to know is that if it goes above fair value, you should be looking to, buy the yen, or short the dollar, right? And as prices came up, you can see this put in this this pin bar here. It's touched our supply, zone from here twice. That probably would have looked like a double top on a lower time frame. Let's say the 4 hour, right? Yeah. So you've got move up and then a move up, and then you've got your your trigger to try and get short right here, right? So again, prices aren't moving because of Fibonacci ratios. And again, I go over this in the video when I talk about is Fibonacci ratio versus value ranges, right? The value range tool, it's just looking at where you are from a psychological perspective, X to A, or the high to the low. Price has been contained in here. This is obviously a cheap or expensive area depending on which currency you're buying, right? And this is obviously a cheap area or expensive area depending on which currency you're buying. Price is contained between the two, right? And if you believe that the yen is the currency to buy, then you're buying the yen at a cheap. This is a bargain area for the yen, and you can see obviously from a risk perspective, prices have fallen away. So if you do want to know, a bit more about how I trade, there are some videos in the description box below. You can feel free to email me, comment in the section box below, yeah, this is just my thoughts. Again, this is not a slight on anybody. If you do trade, bats, Gartleys, and Cyphers, then you're doing it successfully, continue to do so. But just understand that behind it, right, behind the pattern, right, is the psychology, right? It is, prices are not moving simply because it's hit a 78.6 or an 88.6 Fibonacci level. You're buying at value, right? This is the area. And again, doing your fundamental analysis and sentiment analysis behind it, because even candlesticks are not the reasons for reversals. They're just showing information about what people are doing at that area, right? So hope you found this useful. If so, if not, comment, like, subscribe, share, and I will see you in the next video. So if you'd like to receive the best supply and demand Forex levels absolutely free, click on the link in the description box below, enter your email address, and we'll send you the levels that we have just analyzed in this video. You'll get all of the major Forex currency pairs, and you'll get regular updates and never miss a Forex trading opportunity.